Frank Holland joins us now with why transports could be the new GARP stocks. Frank.
Hey there, Melissa. Well, this might be hard to believe, but Old Dominion Freight Lines, a trucking company, one of the top performing stocks in the NASDAQ 100 this quarter, shares up almost 6% as trucking and logistics players continue to outperform the broader market and the mega cap tech ETF for the NASDAQ 100, the triple Qs. And while transports are not growth stocks, to be clear, they're just not. More and more, they're looking like growth at a reasonable price that so many investors are looking for. Since the second quarter, we've heard a lot of talk about a possible freight recession and falling freight rates. And then last month, we had that dire warning from the FedEx CEO that freight volumes were plummeting. We're going to obviously get more insight this month as some of the biggest name in transports, Knight-Swift, J.B. Hunt, Old Dominion, and C.H. Robinson, they all report their earnings. But in their first two fiscal quarters, they've reported revenue growth and EPS growth that's outpacing the triple Qs. If these stocks can maintain this level of growth, they would be growth at a reasonable price just by definition. All are trading at a lower forward PE than the triple Qs that trade at 19 times. Knight-Swift and J.B. Hunt, they report next week. Looks like Old Dominion might be ticking just above that. But still, that's that growth at a reasonable price a lot of people are looking for. The question is, are the volumes still there?
Right. There are a lot of different kinds of transports, obviously, Frank, even within trucking. So I'm wondering, in terms of the valuations, I noticed that some had higher valuations than others. Is there sort of a common theme among the lower valuation ones versus the higher ones? So the lower valuations ones have more assets, for instance, and the other ones are more asset light?
Well, yeah. For example, C.H. Robinson had a higher valuation. That is an asset-light business. Other businesses, it depends if you're a truckload, which means a company just says, hey, I'm going to fill up the whole truck, or less than truckload, where a couple companies say, hey, let me put this pallet in there, let me put that pallet in there. Generally, companies that are less than truckload, LTL, they have a higher valuation. It's more of a cyclical business that can have more spikes when it comes to rates and things like that.
Oh, so they can actually raise rates when they have to. That's a good thing.
Well, that's because, you have people saying, hey, I want to get a load on there.
Right now.
I can't find a full truck. Can I put this load on your truck? And a lot of times that's what companies need to do to adjust to big disruptions in the freight market, like the ones we've seen over the past year.
How is a labor shortage impacting these companies at this point?
Well, there's still definitely a trucker shortage. Yesterday, we had the CEO of Forward Air, another high-performing transport company, on. He said there's probably about 100,000 truckers needed in the U.S. to fill the available spots. He believes over the next 5 years, that's going to grow to 200,000.
100,000 truckers right now?
Give or take, but 100,000.
So truckers right now can command a high salary.
Absolutely. He said he had to raise pay several times this year and also incentivize. And on top of that, you may not think about this when it comes to trucking. This might sound more white collar, but he said, hey, I had to make the work situation a lot better, add amenities, and just kind of talk to them more.
Like in the cabs.
Well, not only in the cabs, but just the work conditions. You want to make sure these drivers get home more often. That's a big thing for a lot of truck drivers. They want to go home at night.
Yeah.